Now, in the meantime, Chinese and Indian gold and silver buying continues to compete with Western ETF demand. Gold is not rising. It's simply evidence that the dollar is being diluted with gold holding its purchasing power. It's that simple. So the de-dollarization process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out of control China orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, with Trump's China posturing. Now, it's all connected in combination with very fresh weaponized geopolitical energy sanctions. That's primarily to put pressure on the core Russia-India BRICS fulcrum, the RICS portion of the BRICS fulcrum. Trump was also attempting to push back against the gold-rich BRICS alliance. Now, what is visible is, alongside the weaponizing of energy geopolitical sanctions, billions of dollars of COMEX gold and silver were created and sold into the market to cap the gold price from breaking above 4,400. Risking, because really 4,400, I mean, that was risking forcing the Fed to buy back upcoming end of month borrowed Bank of International Settlements gold bets at over $600 higher than last month's 4 tons being squared $409 at a loss. Now, the Fed is the only central bank still fighting a rising gold price and has completely mishandled the US Treasury's gold positions. And with 30 tons still to be bought back, plus billions of dollars of the Office of the Comptroller bets, the OCC bets that are visible to anyone, these bets directly relate to US Treasury rehypothecations, double ownerships, and which, so really what it's potentially doing is facing a default into this incredible, physically supported rally. Obviously, a portion of that was not the physical buyers. Now, US Treasury gold positions, so basically still have to be 30 tons still has to be bought back, plus the billions of OCC bets that already relate to these rehypothecations. So that's a real issue. Now, while any other trader would be margin called by their broker and forced to cash settle such enormous unhedged losses, it required, and this is why we know it's official, it required the US Treasury to step in to temporarily staunch the massive de-dollarization flows evident in the gold-dollar foreign exchange cross, i.e. selling dollars to buy gold in the FX crosses. Don't forget, it's a currency. And they would have, so what they did was could have easily weighed up the scope of such a pushback as temporary, though, and directly limited. They would know it's directly limited to how many COMEX speculators could be rinsed out before physical support equilibrium could have been reached. And that equated to a 10% correction. Now, the media has been likening this price smash to they're struggling to find some sort of parity to what's happened in the past, even though things have changed so rapidly. So they would likened it to the 3 year. They were talking about the 3 years ago, the 2013. Oh, yeah, there was a $600 a sell-off from $1,600 to $1,000. Whereas in reality, the scope of this flush was 3 weeks. It's a 3-week gap close that's been limited simply to how many naked long speculators holding open interest could be sucked in before just simply pulling the plug on the strategically timed COMEX-centric margin borrowing cost increase, which by no coincidence came in double whammy as gold was rising. Now, this planted, it's form-fitting. this kind of form-fitting mainstream media analysis illustrates that the mainstream media's lack of understanding of how dislocated the legacy gold and silver unallocated, unbacked, leverage price setting COMEX exchange has become versus the SGE, the Asian, the physical supply demand based price setting mechanisms that have evolved, and that very short term spec induced volatility aside, the COMEX is no longer in just commenced gaining exposure to high quality liquid asset physical gold outside the paper dilated LBMA CME ring fence. Now, what's not being secured and physically removed from underpriced paper diluted local under fixes is being secured in the very liquid Chinese SGE influenced Western facing SGEI, international facing physical exchanges. Now we've been tracking this Beijing to US gold war since 2010, and it's significantly picked up since then. Now this is gaining traction, big time. Gained traction after Russian assets were seized into an openly weaponized US dollar, and in the sanctions that relate to that. And the official de-dollarization gauntlet Beijing literally threw down directly after Trump tariffs were threatened. So they literally openly said, right, okay, you want a fight, we'll have a fight. Gold and silver buying continues to compete with Western ETF demand. Gold is not rising. It's simply evidence that the dollar is being diluted with gold holding its purchasing power. It's that simple. So the de-dollarization process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out of control China orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which will actually be enormously beneficial for the dollar, let's examine the various possible official White House to BRICS pushback options. Now, what could they be? There's really basically a couple. It could threaten to sell all its gold reserves. These things have been discussed. They could threaten to sell all their gold reserves in an attempt to devalue China's BRICS influence. Really? Given that deliberately unaudited US Treasury holdings are to an unknown degree rehypothecated with double ownership claims. So in order to sell its 8,100 tons of gold to effect this pushback, the US Treasury would have to first buy back billions of related underwater Office of the Comptroller bets, which would spike gold even higher. It's too late. The horse has bolted, and the US is left holding less than 1/10 of what the BRICS collectively hold. Less than. So US gold reserves are literally far too small to actually push back. And another reason, and this is another one which we've seen in the past. I think Saylor talked about it. We had various other people in the past pushing back and saying, hey, well, why don't we do this? Especially with the stablecoin mandates being pushed out. So the other idea, and this is what we're going to look at, is that because it's been trial ballooned more recently, that the US Treasury may try to back its 38 trillion of debt. And that's just official. It's much larger than that. But let's just say they want to back its 38 trillion of debt with freshly generated dollar-backed Treasury stablecoins. Now, however, and essentially what they're doing is that would attempt to devalue this 38